I've already talked to people who bought Bitcoin up at 80 or 90 or $100,000
They're okay.
and have dumped it already because they're like, oh, this isn't what I thought it was going to be. But they have no idea what it is because they didn't really do the research on it, really understand it.
One of the most significant developments Lavish highlights is the growing willingness of major financial institutions like JP Morgan Chase to accept Bitcoin as collateral. This is not a trivial change. In traditional finance, collateral is only accepted if it is considered reliable, liquid, and fundamentally valuable. Lavish argues that this move alone dismantles a long-standing criticism of Bitcoin that it has no intrinsic value. Institutions do not take risks on assets they view as speculative or meaningless. By accepting Bitcoin as collateral, they are implicitly acknowledging its role as a legitimate store of value. However, Lavish is careful to clarify why Bitcoin holds value. It is not because it is currently a dominant payment system. He admits that Bitcoin's utility in everyday transactions is still developing. Instead, its value comes from its scarcity and structure. With a fixed supply and decentralized nature, Bitcoin behaves more like digital gold than a traditional currency. This framing is critical. Bitcoin is not competing with Visa or PayPal. It is competing with gold, sovereign bonds, and long-term stores of wealth.
So, I don't want to relitigate it either. So, look,
I did.
the bottom line is, JP Morgan is talking about accepting Bitcoin as collateral. I mean, you don't accept something as collateral unless you believe that it has some sort of underlying value. And the only way Bitcoin has underlying value is if it actually is scarce, if it has limited supply, like Dave is talking about, if it is actually digital gold. Because right now, the Bitcoin as a network for payments it's just not there yet. But Bitcoin as a settlement layer and as a long-term asset, it is there, and institutions are understanding that. Unfortunately, retail is not fully understanding that yet, Dave, and that's what we're seeing. We're seeing the turnover of it, and it's just not sexy enough for the young people to be buying. It's trading at $71,000. And they see that and they think, well, this is not going to go up 100x. I need something that's going to go up 100x. And you guys know I wrote all about that this weekend. The betting, just that mentality. And it's not anybody's fault. And I'm not blaming them because they're trying to catch up and all of that. But the issue we have here is that institutions understand it and they're adopting it nice and deliberately, and they're doing it in a way that it's not causing waves all over the casino in your pocket. Exactly. The Polymarket and Kalshi and everything else. You're just trying to catch up. But the reality is that the news outlets aren't paid to talk about Bitcoin unless there's some sort of controversy. We all understand that. And right now it's just one company after another is quietly integrating Bitcoin into their system, whether it's they're selling to their clients or they're creating platforms for you to use it and actually use it like you would a long-term structural asset, like a bond or like it's like gold holdings in a vault. And so that you have to realize that, and you have to step back and recognize that and have patience. All of this stuff that's going on with Trump and the Strait of Hormuz and the struggle to take control of it. I mean, I don't want to say it's noise, but the market clearly is treating it as noise both ways. And otherwise, you'd see much larger swings in the market. If we thought that this was going to really escalate into something that was catastrophic, the markets would be telling you that. But they're kind of shrugging it off to be true, to be truthful. I mean, look at the futures are down, what, 0.5% as we're going into the open here. And oil is up again. But like you said, crude is at 103, 104. Brent is at 100, 102. So, it's not like this stuff is moving around partially just because of momentum traders, though, and you have to also understand that. But the uncertainty around all of this stuff is causing investors to just sit on the sidelines. I mean, how much cash is Buffett sitting on now? And it's just a mind-boggling number. And so, not that he knows everything, but it's a pretty good indication of what institutional investors are willing to do right now. And so, but we won't relitigate the supply situation with Bitcoin. But just to make it clear, it's very difficult to argue against the fact that it's being adopted on the institutional side. And the reality is there's a lot of confusion with retail. I've already talked to people who bought Bitcoin up at 80 or 90 or $100,000 and have dumped it already because they're like, this isn't what I thought it was going to be. But they have no idea what it is because they didn't really do the research on it, really understand it. Yeah, they're looking for a way to get away from having to hold treasuries, and it's obvious. And so that's why you saw central banks around the world buying gold. They're trying to get away from two reasons for that. And Putin is the one who said it out loud. He said there's two reasons you don't want to hold treasuries. Number one, they can just be taken from you. They can be seized from you. And number two, they could just be inflated away, which is what we're doing. And he recognizes that. And he's like, these guys are just printing money hand over fist. And so why do I want to hold something that I'm going to turn in for, I'm going to trade in for dollars that are going to be worth a fraction of what they were when I bought these things? Why would I do that? Well, that's a structural issue. And that right there, that's the first principle of what the Fed is trying to fight. That is what they're fighting. They're fighting the negative perceptions that are rising around the dollar. And the Treasury needs the help from the Fed to fight that. It's reality. Do I think that we're going to get off a dollar system anytime soon? No, I don't. I don't think we're going to get off but we are going to have problems of issuing as many bonds as we need to at some point here. So it's not something just to shrug off and say, we've been talking about the debt forever. Yeah, well, you can keep talking about it's not going to be a problem until it really is. And I'm not calling for an auction to fail or something like that. Not yet, but it's the writing on the wall, guys. And you better own something that has value. And clearly there are plenty of very large players around the world that believe Bitcoin is one of those things. It's obvious. It's just that, they're doing the best they can to get as much as they can before retail wakes up completely and it becomes that thing that everybody needs to own.
Another key insight from Lavish is the concept of market rotation. In uncertain environments, capital does not disappear. It moves. Different sectors rise and fall as investors reposition based on expectations around inflation, growth, and technological change. For active traders and hedge funds, this creates opportunities to profit from short-term movements. However, Lavish distinguishes between trading and investing. While short-term trading can be lucrative, it does not replace the need for long-term asset ownership. This distinction is crucial. Many investors confuse activity with strategy, constantly moving in and out of positions without building a solid foundation of assets.
The reality is this thing's been around we're going on 17 years now. And so it's not like and it's got over $1 trillion in it. I mean, this is not something that's just going to disappear. It's not. There are so many people who want to own as much as they possibly can. The thought that it's going to go to zero is kind of laughable. The only reason it would is because of some sort of structural change in the code, or that there's an attack on Bitcoin in a way that we cannot fathom right now, which is obviously the quantum, question that people keep bringing up. But beyond that, explain to me how there's suddenly going to be no demand for it. That's absurd. So maybe we can get off that topic, but we're going to continue. This is the way it's going to be until we have resolution out in the Middle East. This is the way it's going to be. We're going to keep dancing around the issues of possible demand destruction from the price of oil feeding into the price of every single good and service out there. That's what we're up against right now. And like Dave said, you're going to see rotations. You're going to be rotations in and out of different sectors of stocks because of it. And that produces opportunity. If you're a hedge fund, you're out there, you're trading these things, you're trading around all these sectors because it's opportunity for you. Well, you've got one camp that is saying that we're going to have demand. There's going to be, you've got one camp that's saying that there's going to be layoffs from AI, and then another camp that and saying that would be demand destruction because you have the economy is turning down because you have layoffs and people are not going to have money to spend on goods and services. And then you've got another side of the camp that's saying, no, we're kind of rocking along here. Everything's fine. And we're, you're going to have either structural inflation because of the oil prices, energy prices, or the K-shaped economy is going to keep rolling here. And, too bad if you don't own assets. The people who do are going to keep the economy going, which, remember, stocks they're not the economy. I think Mike has said this a number of times, and I agree. The stocks are not the economy, but what they do is, it's reflective where people think things are going for certain sectors of the economy, and that's that's an important thing to remember. The S&P is 500 companies, and they're moving around money between them. They're placing their bets on them. They're just moving them around, and that's what you're seeing in the markets. You're seeing quite a bit of rotation in different sectors. This is from Michael Howell's newsletter this weekend. It's a pretty good observation. This is exactly opposite what you're talking about, Mike. I vehemently disagree. The U.S. has not learned their lesson. They're not going to stop printing. They're still fucking printing right now. They're literally buying treasuries. And yeah, so they're buying short-term T-bills. It's to raise the bank reserves, by to a level where they feel like they're adequate, because they need to make sure that the markets, they do not they have no dysfunction. They want to make sure that the banks have enough reserves in order to make sure that there's no spike in overnight rates, and that there's liquidity is available. And so it's absolutely ridiculous to say that they're not going to print again. They are printing. They're printing right now. They're going to keep printing. It's not going to stop. The question is, are they going to print a multiple of what they printed last time in order to save the stock market, like you said, or save all markets, and particularly the bond markets, if there is some sort of credit issue, credit event? I mean, we've talked about the private debt situation, and I don't know if you guys even talk about that in your morning meeting. It sounds like you haven't touched on that too much, but that's a real risk. Is it a risk a la great financial crisis? I don't believe so, but it does have the possibility of becoming something like long-term capital, where you've got a major player that just implodes because they have debt on their books that's worth nothing, that they're carrying at near par. That would be a problem. Would it cause contagion like the great financial crisis? I don't believe it would, but I think it could be contained. But it will require some sort of bailout for somebody. So that is a risk out there, and are we going to have another big print? Well, I do think we're going to have one at some point, especially if you think especially if we do have a sharp downturn in the economy, if we do have a drawdown in the market that causes dysfunction in the credit markets and the Treasury market, we're going to have a print, and it's going to be multiples of what it was before. It's not going to be
that money supply.
It's not going to stop. That's the most important thing for our listeners to understand, is they must own assets. It doesn't mean that you can't trade around them, like you're saying, Mike, but long term, you better own assets or you're going to be left behind. You must own assets. You have to. And that is, I am not going to stop telling people to do that. I'm not going to stop. You have to own them because it's going to get worse, period. I'm not going to stop telling them to do that, Mike. You can trade around it if you want, but you better have a core holding of assets, because if you're not in the market when they do print, you're going to have a V shape like you had in 2020 and be left behind. That's what people are pissed off about. That's why the pitchforks are going to come out, because they feel the K-shaped economy and the wage earners out there are suffering. And so you have, whatever you can do, go out there and get some assets and hold on to them for a very long time, because what we just showed you, the printing on both sides, what on the tweet that you showed, Scott, and what I just showed of the Treasury buying assets, it's not stopping. It's going to continue. It's just a question of how wide open that fire hose is going to be.
If there is one message Lavish repeats with urgency, it is this: you must own assets. In his view, the modern economy is increasingly K-shaped, where those who own assets continue to benefit, while those who rely solely on wages struggle to keep up. This dynamic fuels social tension and economic inequality, but it also creates a clear directive for individuals. Regardless of short-term market conditions, building and holding assets is essential. Bitcoin is part of that strategy, but it is not the only option. The key is to own something that cannot be easily debased or devalued. Lavish warns that those who remain on the sidelines risk being left behind, especially during periods of rapid monetary expansion when markets can rebound quickly, like the sharp recovery seen after the 2020 crash.